All right, all right, all right. Welcome, everybody. This is June Collier. And man, today is Monday, June 13th. Monday, June 13th. And I want to talk to you about stocks today in this particular video. And today was a bloody day. I mean, there was blood in the streets in the stock market. Stocks were down, crypto was down. They even tell me that gold is slipping a little bit. So it has been a very, very interesting day in the market for all of the markets to think about it that way. Inflation's at an all-time high. Gas prices are $5 or higher. I mean, there's a lot that's going on in our economy right now. A lot of people are wondering, which way do I turn? All of the quote unquote investment assets are down with the exception of real estate. But then again, real estate is at an all-time high. Probably not the best time to be buying real estate. So where should you be? Anybody ever heard of the term cash? I think right now, putting your money in cash is probably sitting on cash is probably one of the best things that you can do. But what I want to do in this particular video, I'm just going to be very, very short. We've been talking about, or what you've heard me talking about, is averaging down, using the averaging down strategy. And many people have asked me, what do you mean by averaging down? So in this particular video, I'm going to talk about averaging down, what it is, what's the benefits of it, and then what you have to be careful of, because you can average down in the wrong way and do the wrong thing. So we're going to be talking about when you should use the average down strategy, learning what averaging down means, when to use it, and the dangers of using it as a strategy. And so let's jump straight in and let's just talk about what is averaging down. So averaging down is basically a investing strategy or investment strategy that involves you, the stock owner, purchasing additional shares after the initial shares you purchased, the price has dropped. So let's just say, for example, you start buying some shares at $100 a share, and then the stock drops to $100 a share the next day. Averaging down would be you buying more of that stock at the lower price. Okay. Now, you use this strategy when you believe the market is near the bottom. What do I mean by that? Right now, we are in a bull market. I'm sorry, scratch that. Not bull market. We've been in a bull market so long, I'm saying bull. We're in a bear market. So, what does that mean? The stock market has been dropping. Today, it has dropped. And some of the best stocks that I've been following, that I even hold myself, are at some of unbelievable lows. And so when you think that the market is at the bottom, you may want to use the averaging down strategy. Why? Because you can't time the market. No one knows where the exact bottom is. So the averaging down strategy allows you to begin to invest at a point where you're kind of guessing where the bottom is, but you're not going to know exactly where it is. This strategy will also decrease your average price per share. Okay. It will decrease your average price per share or your cost basis. What do I mean by cost basis? Cost basis is the real cost of the stocks that you own. So if you buy stocks at $100 a share and then you buy some stocks at $90 a share, same stock, but at different price points, your cost per share is going to be somewhere between the 100 and the 90, right? And so this is what we talk about, cost per share. And then it must only be used when you know you are buying a stock at a valued price. Sometimes the stock is just a garbage stock and it's just dropping, right? And it needs to drop. That's not when you want to use averaging down. You want to use averaging down on a stock that you know is at a very discounted price. It is a good price. This is a deal. That's when you want to buy that. If it's a stock that's just dropping in price and you see it dropping, that does not necessarily mean that you need to average down, because the stock could just be a garbage stock and it should be dropping. All right. So that's the thing that you want to be careful of when averaging down. Now let's talk about how do you lower your cost per share. So in this example, we're looking at XYZ stock and it drops down to $25 a share. And you believe that $25 a share is a really great price for XYZ stock. Now you've got about $7,500 to invest in XYZ stock. Now you can invest that $7,500 immediately and purchase 300 shares at $25 a share. But you're not sure if the stock is going to go any lower than $25. So what we do is we average down. We average down. So instead of buying 300 shares at $25 a share, what we're going to do is we're only going to buy $100 100 shares for $25. So we spend $2,500, we buy 100 shares. And lo and behold, the next day, the stock drops down to $20 a share. Whew, aren't we glad that we didn't spend all of our money at $25 a share? But we still think that $20 a share is a good price. So we buy another 100 shares for $20 a share. Now, what this does is it brings our average cost down to $22.50. So we now have 200 shares. We bought 100 shares at 25. We bought another 100 at 20. Our average cost per share is $22.50. And then the stock does something unbelievable. It drops again the next day to $15 a share. So guess what? Knowing that we believe that this is a good price on this stock, we know that this is a value stock, we buy another 100 shares at $15 per share. And so now we have 300 shares of stock. We bought them at $25 a share, $20 a share, and $15 a share. We've got 300 shares. Our net average or cost basis is now $20 a share. Okay. So once the stock goes back up to $20, we're in profit mode at that point. We don't have to go all the way back to $25 because we were buying it at different price points as it was going down. This is what's known as averaging down. And you now have averaged down from $25 all the way to $15, where now your average price or the cost basis for your stock is $20. So when the stock goes above $20, you're now in profit mode. Okay, just an easy way to look at it. You're now in profit mode. Now, there are some dangers of averaging down. Here's some of the dangers. It should not be performed on a company with a bleak future. What do I mean by that? It should not be performed on a weak company. It has to be a strong company that you're investing in. Okay, y'all know my favorite. My favorite company is Microsoft, and right now Microsoft is hurting. It has dropped, but Microsoft itself is a very, very strong company. So I would do an average down on a company like Microsoft. It should not be used if investing for a short-term strategy or short-term investing. So if you think, hey, I'm going to buy this and I'm going to turn around and sell it next week, this is not that type of strategy. This is more of a long-term hold strategy. So right now we see all the stocks that are dropping, a lot of great stocks out there at really they're getting in that buy zone. They're really getting in that zone where it's now for you to start maybe averaging down on some of these stocks. Well, those stocks that you're going to average down on, you may have to hold that stock for a year, 2 years, maybe even 3-4 years. So this would be a long-term investment strategy. It would be one of those strategies where you buy that stock at $15 a share, and then 4 or 5 years from now, the stock's at $45 a share. That's the type of strategy that we're in right now. We're not going to be doing a whole lot of flipping. This is buy and then hold the stock. Buy at a very super discounted price, a good stock, and now hold that stock for a couple of years to see your profits in that particular stock. It also should not be used if the investor does not understand the true value of the company and can determine what is considered a discounted price. So this third one is very, very important. You must understand what price point is a good price point. Just because the stock has dropped 10% does not mean, hey, this is a value, the stock is on sale. You really need to understand the fundamentals, do some fundamental analysis of the stock, understand the fundamentals of the stock, and understand where this stock, when it enters into this particular zone, where it would be considered a value stock. At that point, when it's considered a value stock, start buying it at that particular price, average down, and then you will be in a great situation. Hold the stock for several years. That stock will regain and start making you some profit. Okay. And so this is something that everybody should be looking at. I know a lot of people say, hey, man, the stock market is on sale. Well, there's only certain stocks in the stock market that are on sale. There's a lot of stocks that deserve to be where they are. So you've got to learn how to find the great stocks, look at the price points, and see where they are. Amazon is another stock that's close to entering into that territory. We see, I think Amazon was like at 103, 104 today. We're going to see Amazon, hopefully, this is what I'm hoping, drop below $100. Once it drops below $100, I think you're starting to enter into that territory where you may want to start averaging down. I hear people saying $90. I heard someone the other day say $83, $84. I don't know if it's going to drop that low, but definitely in the 90s. I think Amazon in the 90s is going to be a great stock to hold at that particular price point. So that just kind of give you a couple of things to look at. But when we talk about averaging down, this is what we're talking about. So ladies and gentlemen, thank you so much for watching this quick little video. My name is June Collier. I'm here to show you how to make your money work for you. And remember, all the information presented is for educational purposes only. I am not, and I repeat, I am not a licensed financial advisor. Please do your own due diligence on all the material presented, and do your homework. Do your homework out there. But we're in an area right now in the stock market where you've got to start paying attention, because there's going to be some really great prices on some great stocks that need to be snatched up. So with that being said, again, ladies and gentlemen, thank you for watching. I appreciate each and every one of you. I'll do another video here real soon that talks about some other strategies. But again, this was the averaging down strategy.